Hello and welcome back to Money Moves Daily, your London briefing. It's Thursday, September 4th. I'm Sophia Reyes.
And I'm Jason Miller. Sophia, the markets are definitely feeling the jitters this morning. The pound is under pressure, and you can almost hear the collective sigh from the Treasury as long-dated borrowing costs just keep climbing.
Indeed, Jason. We're facing a significant market event as UK 30-year bond yields have surged to a 27-year high, pushing the pound lower. That's our big story today, examining what this means for the government's finances and the broader economy. We'll also be dissecting the latest UK economic data, including GDP, inflation, and wages, to understand the mixed signals the Bank of England is receiving.
Plus, we've got some quick hits on changes to the FTSE 100, the future of our nuclear power, and the ongoing debate around North Sea energy. And later, we'll tell you why today's GDP numbers are so critical and what to keep an eye on for future inflation figures. So let's get straight to it.
All right, Jason, let's start with the government bond market. On September 2nd, the yield on UK 30-year gilts surged to 5.69%, a level not seen since 1998. This spike is not isolated to the UK, with global bond yields rising, but it puts immense pressure on Chancellor Rachel Reeves ahead of the autumn budget. The market is clearly signaling its concern over the UK's fiscal position, demanding a higher premium for lending to the government.
Okay, so gilt yields means the government has to pay more to borrow money, right? And 5.69% sounds high. What does that actually mean for me and my taxes? Does it mean the government has less money for public services, or that they're going to have to raise my taxes even more to cover these higher borrowing costs, because I'm already annoyed with council tax?
Exactly, Jason. Higher gilt yields directly increase the cost of government borrowing. This translates to either less fiscal headroom for public spending or, as you correctly infer, potential pressure for further tax increases in the upcoming budget. It's a tightrope walk for the Chancellor, who is already under pressure to find savings. The market is essentially questioning the government's ability to balance its books, especially if there's any perceived wavering on fiscal rules.
So, it's not just the Bank of England we're reading the tea leaves for, but now the Treasury too. It feels like every angle is squeezing household finances. Speaking of which, what's the latest on the broader economy? Are we seeing any relief, or is it more of the same?
Well, the latest economic data presents a mixed picture, Jason. GDP is estimated to have grown by a modest 0.3% in the second quarter, which covers April to June. While growth is positive, it's still relatively subdued. The more concerning figure, however, remains inflation. Consumer Price Index, or CPI, actually rose to 3.8% in July, up from 3.6% in June. This is still well above the Bank of England's 2% target, and forecasts suggest it could peak at 4% in September.
Wait, inflation went up again? I thought the Bank of England just cut interest rates back in August. Are they confident that rates at 4% are enough to get inflation under control if it's still rising? I mean, my grocery bill doesn't feel like it's easing, even if they say inflation is moderating.
That's a crucial point, Jason. The Bank of England did cut the bank rate by 25 basis points to 4.0% on August 7th, with a 7-2 majority, signaling confidence in progress towards price stability. However, they've been very clear about a careful and gradual approach to avoid reigniting inflationary pressures. But the persistence of inflation, particularly given the July increase, makes the path for any further rate cuts highly uncertain. Wage growth remains robust at 5% excluding bonuses in the 3 months to June, which is good for workers, but it's a factor the BOE watches closely for domestic price pressures. The market is now keenly awaiting further signals, especially in light of these stubborn inflation figures.
So essentially they're taking one step forward, but inflation is pulling us back a step. It's tough for anyone trying to plan their finances. Let's shift gears for some quicker updates. What else has been moving the markets and making headlines?
Absolutely. In our Quick Hits segment, first up, luxury brand Burberry is making a return to the FTSE 100, rejoining the UK's blue chip index after a year-long absence. Meanwhile, house builders Taylor Wimpey and Unite Group are moving out of the FTSE 100 and into the FTSE 250. This reflects shifts in market valuation and sector performance.
Curious, Burberry back in the big league. Good for them. And on the energy front, I heard something about nuclear plants.
Indeed, French energy giant EDF has announced plans to extend the operational life of two of its UK nuclear power plants. This is a significant development for UK energy security and future electricity supply. And continuing on energy, the debate around a windfall tax on oil and gas profits is heating up again. The UK oil and gas trade group Offshore Energies UK is calling for the tax to be scrapped, arguing it hinders domestic production and could meet half of the UK's energy needs. This stands in contrast to Labour's stated aim to stop new North Sea oil and gas licenses.
Always a hot topic, that one. All right, before we wrap up, what should our listeners be keeping a close eye on in the coming days?
For our What to Watch segment, there are two key data points on the horizon. First, and coming out today, Thursday, September 4th, are the UK preliminary Q2 gross domestic product and factory data for June. These will offer the latest snapshot of the economy's health. Then, further out, but critically important, is the next Consumer Price Index inflation data for August, which will be released on September 17th. Given July's unexpected rise and forecasts for inflation to potentially peak at 4% in September, this reading will be absolutely crucial for the Bank of England's future policy decisions and for understanding the real cost of living for households.
So today's GDP numbers will give us a fresh look at growth, and then a couple of weeks from now, that CPI number for August will be the one everyone's really watching to see if inflation continues its stubborn climb. It sounds like the pressure is firmly on for both Threadneedle Street and the Treasury.
Precisely, Jason. The balance between growth, inflation, and fiscal stability remains incredibly delicate as we head deeper into autumn.
That's all for today's Money Moves Daily, the London briefing. A big thank you to Sophia Reyes for her sharp analysis.
And thank you, Jason, for your insightful questions. Join us again tomorrow for more of the critical financial news impacting the UK. Make sure to subscribe wherever you get your podcasts so you don't miss an episode.
From all of us at Money Moves Daily, have a profitable day.